Bob. So what is Wall Street expecting from the upcoming earnings season? What will the reaction be if expectations are met or missed? Let's bring in Tom Lydon, ETF Trends editor. We also have David Dietz, president of Point View Financial Services. Thanks to both of you for joining us. Tom, I know according to Thomson Reuters that analysts are expecting within the S&P 500 those companies for earnings for this quarter to grow 37% versus this quarter last year. Now, I know it's a relative comp because we've been in a recession, but at the same time, that seems like a high bar. What is your bet that companies are really going to do as well as expected?
Well, you're right. It is a high bar, Melissa. But again, last quarter, there were 6 beats to every disappoint. Again, as consumers are coming back, they're starting to spend more money. I think the numbers are surely going to be there. As far as advising those that might not hit their numbers, there are very, very few, if any at all. So I think it's going to continue to be positive as the trade numbers put out today. Yeah. Very, very positive. Consumers are starting to feel more comfortable spending money, and that's going to translate into better earnings.
David, everybody wants to talk about top line versus bottom line. They're also looking for revenues to grow by 10%. Do you think that's generous or conservative?
Well, I think the 10% is all right, but when you look at the 10% relative to the 37% of earnings, it's just easy math to realize that that size earning increases aren't sustainable. And finally, and secondly, I'd point out that stock investors look forward. They don't look back. So it's going to be critical to see what companies are saying. And when you look at a 9.7% unemployment, I like to see not what they're saying, but also what they're doing. They're not hiring.
Hey, Tom, though, let's look at this. You got a V-shaped recovery boom. Indicator after indicator is V-shaped, including profits. You got a steep upward curve. You got ultra easy money. This is a great country. What's not to like about this? Seriously, right now, this is not forever. The taxes kick in next year. I know all about that. We'll deal with that when we deal with that. But a day at a time here, right now, what's not to like?
Well, Larry, you have to pick your spots. Again, from an unemployment standpoint, David's right. It's high. There are concerns. But if you look, for example, overseas, emerging markets, they're through the roof. They're past pre-recession levels. And people are starting to spend more money. Luxury goods sales, again, increasing. Technology, more and more people and companies are upgrading in those areas. So if you pick your spots, this momentum is going to continue, and you'll continue to participate. The Kudlow market melt-up is in full bloom.
Not forever. I'm just saying, right in here, before the tax man hits next year, I don't know.
Let's pick up on that, because not forever. David Dietz, at what point do investors start getting a little nervous about the tax man kicking in next year, about these Washington policies really taking effect on the economy? We know that investors are looking 6 to 9 months out. So what does that tell you about the investing scenario in the next few months? The
tax situation does not look good, Trish. I mean, basically, we need to get debt as a percentage of GDP down to 3%. That's going to require an extra $500 billion a year of cash flow. We can't just tax the wealthy in America. You got half the people in America are no longer in paying taxes, and so they're going to be looking at consumption taxes, VAT taxes, and I don't see how that can do anything good for the economy and therefore for the stock market.
78% top tax rate, according to the Tax Policy Foundation. 78% top tax rate.
And you know that basically half of Americans aren't even paying a tax right now.
And that's the group that has 80% of the capital which we need to invest and create business. Can I just ask a point, though? This is a little bit of bearishness. Import prices came out today. David Dietz, let me go to you. Import prices were up 0.7%. Nobody hardly pays any attention to this stuff. They should. The last 12 months to March, up 11.4%. Contrary to the Fed, there ain't no deflation, and there might even be a hint of inflation. You have a thought on that?
Yeah, absolutely. I think one of the risks going forward here is we're going to be in a rising yield environment because the Fed's going to be looking at that as incipient signs of inflation. They're already talking about raising the discount rate a second time. They're ending their mortgage securities buyback program. So as interest rates go up, that's going to put pressure on the stock market because fixed income is going to look more attractive. It's going to increase borrowing costs for corporations and consumers. That's a real negative going forward.
Okay, so Tom, given everything we've said so far, how do you play it?
Well, I think, Melissa, again, you got to pick your spots. From a consumer standpoint, there are many great ETFs out there if you diversify. Technology is definitely the way to go. And if you haven't had that position in emerging markets, you haven't missed the boat. It's going to continue. And the Vanguard World Emerging Markets ETF with an expense ratio of 0.27%, you can't beat it.
David, real quick, what's your best play right now?
Telecom and utilities. We're looking for high dividends, great franchises, and areas that have lagged this market as a defensive play.
You selling bonds? You're selling bonds.
We're shortening up the maturities. We're preferring treasuries over high yield. The spreads that high yield commands over treasuries have now shrunk to their lowest level since before this chaos started. So that doesn't look like a good risk-reward play right now.
You own any municipal bonds? You know, all the various greases in America, California, New York. I don't want to say New Jersey because the governor in Jersey is doing a good job, but, you know, you have these little greases. Illinois, let's put that in there. You guys own any of that paper?
You got to pick your spots, Larry. I mean, obviously, I don't think this country's going to let California fall into the Pacific. So right. At the right yields, those can look attractive.
Well, the IMF's going to come in and rescue California. It's going to be an IMF rescue
Okay, let's
mission.
leave it there, guys. Thanks so much for joining us.